This entails economic data, that is like interest rates, GDP reports, geopolitical events, and major news announcements. All these things impacts a country's economic outlook. They impact the well, most of us that are trading, you would have already know what we are talking about. But the beginners, watch out for all these effects. So we have three types of how would I say it, analysis. We have the fundamental analysis, technical analysis, which is what we're looking at, technical analysis. Then we have the sentimental analysis. Sentimental analysis is quite synonymous to fundamental analysis. So if you are not careful enough, you might be thinking sentimental analysis is same as fundamental analysis. However, there are two different things. So now we have what we call the liquidity hunt. Now, what is liquidity hunt? Liquidity hunt is large institutions often target areas. Please mute your mic. Please mute your mic. All right. So, sorry. Liquidity hunt. Large institutions often target areas where many stop loss orders are clustered, sweeping them to gain liquidity for their own large positions. Okay, let me explain what that means. For instance, you have something like this. Many uninformed traders are here looking to buy a particular asset at, let me say, so let's assume we want to buy a particular asset at $10. And the big boys, these are the institutional traders, the big boys, we call them the big boys. They want to also buy at this zone. This place is a psychological level they want to buy from. Do you have your small $500 in your account that you want to use to buy from here? Because you're a good trader, you have actually anticipated that the price will definitely come to, let me say, $50. So hopefully you're looking to get $2,500 profits based on your lot size, position, and whatsoever. So you've entered your position here. The big banks, on the other hand, all have seen what you want to do. Or in fact, they've seen the market and they've seen that, yeah, this is actually the best area. This $10 is actually the best area to buy from. What will they do? They won't buy from here. Why? Because their own money is even much more larger. Why? Number one, the executors, which are, let me say, MT4, MT5, then they cannot process their orders. Let's assume they want to trade $10 million. They want to trade $10 million on this same asset you are looking to trade $500 on. They cannot just enter the whole $10 million position here. If they do that, there's something they call volume imbalance. The price will not trigger their executions at $10. The price might trigger it at, let me say, $15, making them automatically lose $5. You understand? And even the big banks can easily get stopped out. So imagine you placing trade, you already lose $5. And then trade still comes to stop you out before going up. When we get here, we understand. What are they going to do? They will just, let me say, just take a little amount of this $10. They might just take, let me say, $2 out of it and sell. So that at least the effect of this $2, perhaps the effect of this $2 on the short effect of this $2 might just be that it will just push the price down a little. At least if they want to buy and the price wants, if they want to put their sudden market execution, and because they want to accommodate what we call volume imbalance, they want to execute somewhere around here, or they want to enter at this $10 price here. They will push the price down a little with this $2, and perhaps let me say the effect of that $2 is that the price will be pushed down to, let me say, $9 or $9. Let me just say $9. These are hypothetical figures, please, not necessarily a definite figure or defined figure. These are hypothetical figures. So once they see that the price has dumped a little bit to this down, our uninformed traders would think, okay, price has already broken this psychological level, so we are looking for a retest and to sell. So they will start looking for sales, start selling. Those that are going to enter here and put their stop loss around here or around whatsoever they want to put it, and then put their take profits around this zone. Sorry, my drawing is very, 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 very bad. Jesus. Somewhere here, these are SL, these are TP, whatever. Just because of this small sudden dump in price, they will be in profit here. However, this is when the institutional traders want to now buy, because once they put their order, the price will surely jump up, and then hopefully speaking, they'll be able to buy it at this $10. The price will all of a sudden start going up. Then the uninformed traders do not really know what they're doing. They'll not be like, ah shit, this forex is scam, crypto is rubbish, this is this is that. Yeah, the one that did not actually know what is going on in the back end, bro. So that's why it is not, as a trader, please, one lesson you should know, or you should even take home tonight, is FOMO. There's something they call FOMO. FOMO means fear of missing out. Fear of missing out. So you see this, how will I say it? This scenario here, when price start, your, how will I say it? Your initial position was that you wanted to buy from this $10 to this $50, but just because you saw that your psychological level got broken, you now want to start jumping so that you catch the sell. It happens to even advanced traders. So, but your ability to sit on your ends, to understand liquidity on stop loss on manipulation, will tame you from taking irrational decisions or to save your money. So FOMO is one thing you want to fight against. You don't want to be caught as a victim of FOMO, regardless of how sweet the price action looks. You can see gold. If those intermediate traders or beginners that are looking at chart already, then the advanced traders, you see gold. Most people are looking to buy. If you have not seen a right POI to buy from and you are jumping into the trade, your SL will be used as sacrifice in the market. You just dash your brokers money. A small $10, $100, whatsoever dollar, you dash them. So please be aware of FOMO. It affects both beginner, intermediate, and advanced. You will experience such emotion. You experience it. But your ability to sit on your ends will actually save you a lot of stress. So it's better you don't trade than to lose your hard-earned money to people that already have large money like in their bank accounts. So who is in the market? Who is in this market? Who are the people who trade in this market? The first person we see are the central banks, liquidity providers. We have the corporates and exporters or importers. We have the commercial or prime banks. We have the hedge funds, asset managers. We have the brokers of brokers, retail traders, name them. Do you understand? So every participant actually plays a distinct role, contributing to the dynamic and the complex ecosystem of the forex market. Forget that we are actually centering on forex markets. We can also use the same strategy on every every market that is represented with candlesticks. Do you understand? Or line graph too. We are not going to we are not going to line charts. We just talk about candlestick stars or brokers. What you must know about brokers. We have types of brokers. We have the ECN, or you can call them STP. If you hear STP, that's still the same thing, that's straight through processing, or electronic communication network. These brokers route your orders directly to liquidity providers. They typically charge a commission per trade and offer raw spreads. These are ECN. This is what most of us use. This is what most of us use, ECN or STP, anyone you call it. So it's the ideal one for small fries. We call ourselves fries, or small traders or retail traders. Whether you're using SMC, ICT, Wacom, whatsoever, we are all retail traders, because what actually distinguishes a retail trader from an institutional trader, I will still keep on saying this. What distinguishes a retail trader from a what's it called, an institutional trader, is not your trading strategy. It is your liquidity, your money. How much are you actually using to trade? Do you understand? So you can be a retail trader and be using SMC's trading style. You could be a retail trader and be using support and resistance. You could be a retail trader and be using ICT. You could be a retail trader and be using whatsoever you want, anything. You can name them. You are still a retail trader, regardless of the kind of style you are using. Do you understand? So we have dealing decks, which are the market makers. These brokers often take opposite side of your trade. It is their culture, because they believe that 80% of the retail traders, who are the retail traders? The retail traders are we uninformed traders, number one. Retail traders are we that owns very, very small amount of money in the market. When I mean small amount of money, I mean like your $5, $10, 50 to 1,000, $10,000, 200. Even though you are using anything below $1 million, you are classified as a retail trader. If you cannot open a trade with $1 million, you are classified as a retail trader. You are classified as a retail trader. So these brokers often take opposite side of your trade, creating an internal market. They profit from the spread, and they may have less favorable execution. That's why you cannot use your small money to trade with market maker. I want to work. So another thing you should know about the brokers is the cost. We have what we call the spread. What is the spread? Spread is very simple. The difference between your bid and ask price, or your buy and sell price of a currency pair. That is just the meaning of your spread. So bid and ask, or buy and sell. Do you understand? That is just the meaning of what spread. They also have what we call commission. Commission is the charge changed. The fee charged per trade. That is common with what we do. We have commission. There are some that claim they do zero commission. There are some very low commission or whatsoever. So the most popular and the most popular broker type we use is ECN or STP. That's what we use, and they will definitely charge. This is where they get their only two money from, and the likes like that. So they have what we call the swap fee or the overnight. That is a spillage or whatsoever. We have the swap is the interest adjustment for holding position overnight based on the interest rate differential between two currencies. So the two currencies you could be trading Euro USD. You could be trading what? Euro USD, EU. And you mistakenly hold it overnight, or you intentionally hold it overnight, just so that you remove a particular amount of money from either your profit or your loss. Do you understand? So it depends on your broker. They know the amount, but it's very, very insignificant, very, very small, depending on the kind of volume you are using to trade, or the lot size you are actually using to trade. So we have quality and safety. Always evaluate your broker based on the execution speed, spillage, server stability, regulations, segregations of funds, and what repetition. So before you start trading, make sure you vindicate your broker if they are not imbalanced. Make sure the kind of broker you want to trade with are the brokers that actually have the interest of their traders at heart. Don't just trade with any our broker that will delay execution. Don't just trade with any our broker that they can just pack off anytime. They are not regulated by any financial body whatsoever. So please, don't worry. Those ones are not difficult. So we have accounts and leverage. This is just the introduction part. So on the kind of accounts we have demo types, we have NDB, that is a no deposit bonus, we have the prop firms, we have your live account. So it is always advised to start with a demo account as a total beginner to practice risk-free before risking your real money. Do you understand? However, so we can add, but I don't really more or less encourage most of my students to use demo. I don't. I would rather say you wait for a no deposit bonus, or still you buy a prop firm. Don't touch life yet, just to remain calm. So it's either you trade with a no deposit bonus account or you trade with a prop firm. The difference between this no deposit bonus and demo is that demo, how will I say it, your emotions won't be attached. And in trading, your emotion is extremely important. That is, your ability to be able to tame your emotion is extremely important. It is attached to your psychology in trading. Why trading? It is attached to your psychology when trading. So demo will not give you that feel of emotional saga. It will not give you that feel at all because you already know that you're not. If you lose, you can easily click the restart button. You start from the any amount you want. So you won't be serious. You won't take it very, very seriously. But when it is no deposit bonus, you know that okay, you are promised. You know that okay, if you make some particular profits, you trade very, very well. You money, something is attached. A profit is attached to you that you can actually withdraw. Unlike your demo, all your profits you can't withdraw, it does not have any effect. All your losses too does not have any effect on you. You can easily reset. But when you lose your no deposit bonus, you've lost the account. You then have to stress yourself or you wait for another no deposit bonus before you can now trade and things like that. So at least the lowest or my recommendation is that for your practice you get a no deposit bonus to trade with. Do you understand? Or better still, get a prop firm. With these days now, we can now get prop firms of $1,000, $2,000, $5,000, and the likes like that. Let's get the cheapest you can actually get. Then trade with it. Use it to practice whatsoever you be taught. Use it to practice whatsoever you studied. Use it to enhance your trading edge. You to refine yourself to know how to get your psychological balancing and the likes before you now start trading your fund, your life accounts. At least you should be able to pass your phase one, phase two, and become funded before you can even say you want to start trading your life accounts. And for my students, I won't really advise taking signals or relying on signals. I won't really advise that you, how will I say, you become so dependent on one person giving you signal. It is not too good for yourself. It's not good for you as a person or as a trader because anything can actually happen to that your favorite signal provider. Anything can actually happen. The person can travel out, or the person can just lose concert, or the person can just lose interest in sharing signals again, or God forbid, the person can be very, very sick and won't be able to operate the system again. How are you going to get the money you have been getting since all these days? Perhaps you're using signal to feed your family or to just guide yourself or whatever. You will be jumping from one other signal provider to another signal provider. It is not LD, it's not reasonable, it's not advisable. I don't do such. I won't tell you to not to take signals, but the only advice I will tell you is that for you to become a better trader, a seasoned trader, don't take signal. study by yourself. If you can trust a signal provider that you can risk your money, why don't you study and put that same trust on yourself and risk the same money you have been risking on the signal provider? So go through the pain, go through those losses, and learn how to tame them, tame your greed, learn those things by yourself. Don't just depend on that fisherman that is giving you fish. Let him teach you how to fish. Learn how to fish. Watch what he or she is doing. Then you do it by yourself. That's how you grow. You permit growth to yourself. Don't just be so comfortable taking people's signal or whatever. You to try to be yourself to become a signal provider. That's why you are here. So we have what we call account types. We have the ECN, like I've said. We have the raw account type, standard account type. We have the set accounts. They offer different trading conditions. Examples are minimum trading size and spread structure. Any type of account type you want to take are not bad, depending on how much you have. They are not, those things are quite basic enough. Leverage and margin. Now, what's leverage? Leverage actually allows you to control larger positions with a smaller amount. Let me explain this of capital. Now, your leverage, we have different kind of leverage. We have 1:1, we have 1:2, 1:10, 1:50, 1:100, 1:200, 1:500, 1:1000, 1:2000, unlimited, depending on the kind of broker you're actually trading with. And I believe most pro firms they do 1:100. They do 1:100. Why some do 1:50, depending on whatsoever. So, assuming you are trading with let me say, an $100 account, and you are using a leverage of 1:500 on an $100 account, that you can't use every lot size. You can't use there's some there's some pair you want to trade that you can't use 2 lot size, 1 lot size on. So you would have to go to your leverage to increase the leverage. And please note, the higher your leverage, the higher the risks, and that means the higher the amount you are going to lose, or the faster you will lose your money, and also the faster you will gain profit. So just know, leverage has its own advantage and also has its own disadvantage. So if you are looking to increase your leverage, know that you're also increasing the potential to lose your money or the potential to gain more profit. Now, margin. Okay. Yeah. There's a causal relationship between leverage and margin. Do you understand? There's a causal relationship between leverage and margin. Leverage is just basically your 1:, whatsoever. 1:500, 1:100, 1:, blah, 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 blah. You understand? So your margin now is not going to be the amount of that your leverage. Let's assume you are using 1:100 and you are trading on you are using, let me say, $10 to trade. Your margin will be increased based on your leverage. If you open a demo account, and let me say you open another $100 demo account and you leave your leverage at 1:100, you place a particular trade depending on the lot size. When you place a particular trade depending on the lot size, you will see where they have balance, equity, margin, free margin, and whatsoever. Check the margin and see how much it is. How much is here? That margin is the amount your broker is borrowing you to trade. Meaning, this is the volume you're actually using to trade. Not assuming you're using $10, your leverage can increase to $100 or $1,000 depending on your what. So your margin can increase to $100 or $1,000 depending on your what leverage. Do you understand? So why your I've already explained this. Why it amplifies your potential profit, it also amplifies your what your potential losses. So use it what responsibly. Use it what responsibly. Now, platform orders, platform and orders. We have MT4 and MT5. Industry standards platform for executing or execution and charts, then automated trading, that is your E, that is your robot or whatsoever. So, like I've said before, you have MT4, you have MT5. These are used for executing trades. That's just to place your trade to enter your trades. Do you understand? So, I should join again.
Yeah.
No, I can hear you. I don't know, maybe it's that person.
You can hear me now.
No,
You
I
cannot
can hear
hear me.
you clearly.
you're not.
I
Somebody
can
can
hear you.
hear
I can hear you.
me.
Someone can hear you.
Yes.
Okay, maybe it's from my end.
Very
Okay,
clear.
okay, I hear you. Okay. I mean, I want to say good night. Yeah. Join the game.
Yeah, don't good night you. Very,
Ah,
very clear.
okay. The meeting will even soon end in the next 10 minutes. So don't let me just bamboozle you guys with too much talk and talk here and there. So if you have any question, let me hear from you. So our next class is going to be on Thursday. Our next class is going to be on Thursday. We just continue from where we stop. We stopped at platform. And all these things are always pretty basic things that we ought to know as traders. And if you don't know it, to mess us up somehow. So any questions so far before we call it a switch? As a digital concept, this is the last place. Just risks and stop loss. So I need to explain all this. Let me explain it. We're almost done. Just quickly finish it. Yeah.
Sorry.
All right. Thank you. So we have what we call trading view. Risk trading view is actually popular. Is what we used to actually analyze. So people use MT4 or MT5 to analyze, but it's not, as far as I'm concerned, it's not as flexible as trading view. We also have different trading platform, but I think the best free trading platform that I know is trading view, and it's very, very common and popular that way. This is what most people use actually. So trading view. It's actually very, very good if you subscribe for their premium trading view or pro trading view. You get several tools that are not for free. You get them there if you can use them to actually help you a lot. Let me see. Sorry. Order types. We have different kind of order types. We have market order. We have limit order. We have stop order. What is market order? Market simply means to buy at the current market price or to sell at the current market price. You understand? That is to execute the trade immediately. As you are pressing the buy on market order, it is buying immediately. It's opening a buy order immediately. As you are pressing the sell, it is opening the what? A sell order immediately. That is what we call this market order. Do you understand? So we have the limit order. Limit order simply means to buy at a specific area or to buy at a specific. Sorry, hold on, please. Sorry, you're looking for. You're looking for. Right, 1 for 1.